Peter, how are you, buddy? Welcome to Face. Glad to have you here.
I'm
Uh,
here. Can you hear me okay?
got? Can you turn it up just a little bit, buddy? The volume.
I think it might be okay, Dale. Sometimes the
Okay.
microphone needs a few seconds,
Okay.
to auto adjust the volume.
All right.
Yes.
You're good. You're good, Peter.
All right.
All
Good
right.
morning.
So, good morning. Very nice to meet you again. Sorry about that day. I didn't have internet service. It was just, a day. Poor people in Texas that still don't have power. Can you imagine having leverage positions on and not being able to do anything? So I have some, trader friends there. So let me ask you, Peter, you're going to share your screen, right?
I will be glad to, yeah.
Okay.
So
Is that
you want
green
me?
box?
Yep, yeah, I got it. I cannot start screen share while other participant is sharing.
Yeah, Steve, you have to stop sharing.
Done.
Thank you, buddy. Okay, Peter.
All righty. Hopefully you guys can see that.
Okay, so you prepared. You told me you had a PowerPoint. So before we get into the PowerPoint, Peter, can you just give me a little history how you got involved in trading and forecasting, etc.? What was, say, for example, your first gig in the trading business?
So I am not a professional trader. I'm an actuary and economist by training. I spent most of my
Okay.
career in health insurance, actually, as an actuary. So became very facile at financial model building. And in fact, my father's a statistician. I'm versed in time series. So I come from it, from a
Yeah, DNA. It's in your DNA.
yeah. I was programming matrix inversions at 13, with my dad. So
Right.
I've come to it more from from an adjacency. Okay, so I'm like, it's more of a passion. So what I did was eventually, I lost, made some money back in the dot-com bubble, lost money. I felt like I was not really knowing what I was doing in the market. I didn't have a process, a system. I looked for processes and systems. I had a boss at the time who was doing the same thing, because he was interested in the markets. And ultimately, I backed away from, kind of like the trading approach where I'm going to allocate my capital because I think this about that company. But eventually I came upon, using my technical background in model building, financial model building, a way to design an allocation scheme that's systematic. And
Okay.
it got me thinking about the nature of systematic investing. And that's really kind of what I was coming to the table to talk about a little bit today is, systematic investing and how traders can think about what they're doing within that context. And I know that doesn't, most traders probably don't think that they're actually running a system, or people like you are sharing your screen and showing charts really think that they're, using a system. But in fact, it's my position that everybody is. What they just haven't done is necessarily programmed it or set it down in rules and a heuristic. Um, so that's kind of what I, was coming to the table to talk about today.
Okay, great. All right, so I'm open. We learned from everybody. Appreciate you preparing a presentation for us, Peter. So take
Yeah,
it
yeah.
away.
So first of all, I have to say that I am and my partner are in the middle of raising, a fund. This is not in any way a solicitation to join the fund. My lawyer made me put this in, so just
Okay,
want to be clear.
we've got your disclaimer. Okay.
Got my disclaimer. So let's talk about the characteristics of systematic investing. It's systems are rule driven, no discretion, numeric representation of a core allocation thesis. Okay. So traders and even chartists are doing that. They just haven't got down to the point where they're necessarily laying it out in a heuristic. So I was watching you with your screen, showing trend lines, and I've done the same thing. And every trader, everyone who's visually oriented, likes to look at things that way. But you could theoretically go and program exactly how those lines should be drawn. Okay, and
Okay.
when the line should be changed, and what conditions would make you want to sell or buy based on the structure of what your logic has created. You're just doing it in a very shortcut way. People are visual, but there's nothing stopping anybody from taking what you were doing there and turning it into a system, and then ultimately proving its worth by backtesting, by application to multiple scenarios and environments, and demonstrating that you can generate returns that are in excess of the market by doing that. So
Right.
the approach that I've kind of taken to thinking about what I'm doing, and the concept that I really want to get across today is that price movement is the opportunity. Okay, and the goal for any investor should be to capture as much price movement into their returns as they possibly can. Okay, and there's multiple ways to go about doing that. You can create a system or a process that you apply on occasion when the probabilities are deemed to be in your favor across different asset classes or stocks within an index or stocks across indices or paired trades. So there's many ways to capture all the price movement that occurs in the market. And the goal is to capture enough of it so that you're exceeding the returns of the market with regularity. And I don't want to say risk adjusted because I'm not necessarily a believer in the efficient market hypothesis and that construct. But that's really the goal. So price movement is really the opportunity. And I think about systematic investing in terms of systems or processes that can be demonstrated to produce value over different time frames, and then stacking those processes. Okay, so let's say that I have a model. No, buy and hold is a system. So
Okay.
you enter at point X and you get out at point Y. That's a system. You capture only one part of price movement. If you have a trend following model, it may tell you to be long now, be short now, be long now, be short now, and you have an opportunity to capture much more gain into your process. If that system works, then buy and hold. So the concept is to find processes that work over different time frames, stack them, meaning unbound yourself between keeping your portfolio between 0%, in anything and 100%, long. So the opportunity to use leverage where leverage is in your favor is also a critical concept. So illustrating that, this is just a simple example of, hey, I bought on January 2013 and now I've got these gains, buy and hold. If you had a trend following process that said, hey, the momentum of the market is fine, it's fine, I'm long, and then here it says it's time to get out, okay, and I go short. Either you get out or maybe even go short, you've captured that price movement, whereas a buy and hold system only captures the point-to-point gain. So it's not a terribly complex concept, but the more granular your processes get, the more price movement there is to take into your system. Okay. The corollary is that systems that are neutral to the market are obviously to some degree missing opportunity because it doesn't have a position on the price movement that's happening.
Right.
And the more granular you think about this and you get to the point where you go, hey, high frequency trading, what are they doing? They're getting down to the
Milliseconds. Yeah.
the subatomic level
Yeah.
of the market and capturing mini gains at high frequency, that in price movement. And so you can start from that very granular level all the way up to the macro and talk about how you can stack processes and that are orthogonal or independent to gain more than the market. So that's the concept that I really wanted to talk about today. I'm going to stop there and see if you've got questions or anyone else has questions.
Okay. I know you have a presentation. Does it include that you have models, proprietary models that forecast secular changes in markets? And
Yes.
okay,
So that's the first system that I built was what I'll characterize as a mean reverting
okay,
valuation driven model. So it's an allocation scheme that says the higher the market is valued, the less you want to be in the market. The lower the market is valued, the more you want to be in the market. And obviously that's buy low, sell high. That's obvious, right?
yeah,
But the point being is that it actually, if you unbound yourself from thinking about, hey, I want to be only 100% long, there are opportunities understanding valuation to know that you actually should be levered long to capture high probabilities of gains. One of the principles embedded in this is that in general, if the market isn't suffering, if the underlying economy isn't suffering from persistent declines in corporate earnings power, the market just has a tendency to get more expensive until that occurs. So there's a tendency that the market goes up, and the more undervalued it is, the more levered you should be. And as you get more overvalued, eventually you should be out of the market and even short. Okay. So this scheme is driven by a proprietary valuation model using using corporate profits from the national income and product accounts that the government publishes. And so the basic concept is that equities are valuation should be a function of the size of the economy, nominal GDP, and how much corporations are pulling out of the economy in terms of earning power. And I don't just mean S&P 500 companies, I mean the entire economy. And one of the conceits of the model is that the observation that the government data on corporate profits actually often disagrees with what companies are publicly reporting, because companies can publicly report their earnings more favorably than they really are from an underlying economic perspective for some period of time. One of my roles at a large health insurer, which I won't really say publicly because you can find out, was to be the valuation actuary. Okay, so you're making estimates of what your earnings are, and you at any point in time you can keep fat on your balance sheet. You can have reserves that are overstated, and then as things kind of like you miss your estimate, well, you can change that fat, and you drip that out into your P&L, and you hold your earnings up until the point in time where you have no more fat in your balance sheet. Okay, and so when secular turns in the market occur, it happens because the underlying earnings power of corporations are declining persistently. Publicly traded companies won't recognize that that's a persistent trend for some time, and they will do what they need to do to hold up and meet their earnings expectations. Up until the point in time when it's obvious to everybody that, hey, we're in a recession, corporate profit margins are plummeting, and then everyone gets a free pass to admit that things aren't that good, and then they to have a kitchen sink quarter and so on. So the way that goes back to my model is that turns in corporate profit margins in the NIPA data actually lead turns in publicly reported margins by a full year. And that allows you to create a structure so that if you observe that, you should be shifting your allocation scheme. And that's exactly what this graph here is showing, that in my model, when my logic says, hey, this is ripe for a secular bear market. And what I mean by a secular bear market is something that lasts, we'll call 9 to 18 months and is punctuated by persistent declines in corporate profitability. Then your allocation scheme in my model is still a function of relative valuation, meaning how cheap equities are or expensive they are, but they shift to a much more conservative stance. So that's
okay.
the model.
So, what's your model saying in these market conditions and structures? Based on a valuation model, would you say there's not that much value left in the market with valuation levels and rates going up?
There is not much value. In fact, there is no value left.
Okay. All right. So your valuation driven model would be how much in cash?
Actually, it's 100% short.
Oh,
So
okay.
short.
That's that's definitely a statement. Okay. So how long have you been 100% short? Is this a recent position that you've taken with the model?
That's actually since November.
Okay.
So it's obviously taking a drawdown, which is a characteristic of a mean reverting scheme. So
Yeah.
the concept is that the markets can in fact go higher. I can't say when it's going to turn. It's you take drawdowns, but you position yourself to capture that. Now that kind of leads to why I'm working with another model developed by a partner that's more price momentum oriented. So that price momentum oriented model makes decisions on much shorter time frames and goes between flips between long or short. And
Okay.
that model in and of itself as a standalone model performs very well. But when you overlay it on top of my model, which is a mean reverting, valuation sensitive model, they actually, the gains, compound between the two models. So
Right.
said another way, a price momentum model says it's okay to be long right now. So if my model is 100% short and the price momentum model is 100% long, that effectively makes me flat to the market as
Got it.
opposed to literally being short.
Mhm.
So that's the concept that I want to get to, is that you can take two independent systems that as long as they're uncorrelated in terms of decision making and time frame that they work on, and that means you can then overlay those two systems and take the gains of either system into your price movement. And the
And
more
your shorter term system is called a momentum system, Peter?
Yeah, it is. It's my partner Dan Weiser, who you can also find out there on Twitter.
Okay.
Developed this. I helped him kind of turn it into a process, but the concepts are his, and
Okay.
it's very much like based on RSI 5 and other internal measures of market strength. And so it's
Mhm.
literally a logic-based process where it's a if then else, decision. It's not Dan looking at the day and saying, "Hey, today I feel like being short," or "Look, I think this is really a long." It's a logic-based process. Then you could then back test and demonstrate the value over time.
Okay. And what would you say allocation would be between the two models? Equal?
So that's what's a little different, and a lot of people think of it that way. We're not going to allocate capital between them. The two models actually work together.
Okay.
So the allocation stacks on top of each other in our process. And we plan on capping leverage at 2 times long and 1 time short. But so, for example, if my model says, "Hey, it's 50, I'm 50% long," and Dan's model says it's a short right now, we would actually be positioned at 50% short. Not 100% short and not 50% long, and vice versa. So right now, the stacking is that my model is says short, his model says long, and that makes us neutral. So it's not an allocation between the two models. It's actually stacking two uncorrelated processes, allocation schemes on top of each other.
Okay. So so then you probably have a lot more conviction about the shorts when the momentum model would flip and you'd be on
Exactly.
on the same page. And we've had some sell-offs, and I do some momentum work, and definitely I mean there's been all kinds of momentum divergences and non-confirmations. Is his model close to flipping back the other way to
Uh,
short?
I do not have Dan's probably on the line,
Yeah. Okay.
but to think of it this way is that if it takes probably 2 to 3% decline off of the top prices to
Yeah.
really even talk about the possibility of it starting to flip short.
Okay.
So it's the market's got a little work to go, but frankly, once it goes short, the potential for more meaningful declines are there because of valuation. So think of it as the conditions are ripe for meaningful declines in prices, and that once momentum says that the market is no longer actually trending, that enhances the potential for that. Doesn't guarantee it. There are
Nothing's, yeah.
no
So, Peter,
yeah.
let me ask you this. When you talk about mean reversion with the S&P's trading over 3,900, does your model tell you what mean reversion is ahead of time or once you get there?
No, see, that's the one thing about mean reversion. It's not predictive, okay? It's about positioning for it and having a
Mm-hmm.
process to allocate appropriately for the tendencies of the market. And that confuses a lot of people who are more trading oriented, because you think you have to be making calls at any time as to whether or not the market's really a buy or sell, and if you lose money and take drawdowns, you have to stop out of it. This process has no stops. It's a continuous allocation scheme. So mean reverting means that if the market continues to go up, you get shorter. Now in my model, because of risk control, I do cap at 100, at one time short. The market can get more irrational, and you can go bankrupt levering short. You're way more likely to get rich levering long than you are levering short.
Okay, and how do you participate on the short side? By actually going out and shorting individual issues or ETFs? What's your approach for playing the downside? What
This
kind
is
of instruments do you use?
this is purely S&P 500 market timing.
Okay,
That's it.
okay. So if you were short, what you could be short spies?
Yep, options.
Okay.
Different options have different instruments have different risk characteristics. In a
Mm-hmm.
mean reverting model, you don't ever want your position to be taken away from you. Meaning, so probability of ruin is a very important concept in doing mean reversion. So you have to use instruments that you control. So I have personally favored options on S&P 500, on SPY. It also, that requires, obviously, as price moves, delta moves. So since we target market exposure, you have to constantly kind of titrate, exactly what the exposure is to the portfolio. So if market says, hey, you're 150% long, and the market goes up, and you're using options, well, the delta goes up. So that means that you need to titrate and sell options to get back to your 150% long position. But futures don't have that characteristic. But futures are way more tax efficient and way more kind of leverage efficient. Problem is that you can run out of margin, right? So it's, I use a mix of instruments depending on the circumstance. So, for example, in March of last year, I was not touching options because of the high VIX. Even if you were right, as VIX came down, you were likely to give your gains to somebody else. So I was at that stage using levered ETFs, again, because the margin characteristics. So it really depends on the characteristic of the market, what instrument makes the most sense.
Okay. So Peter, we have a few minutes left. Anything that you want to wrap it with, and perhaps you want to show if you have a website or where people could reach you if they want to delve more deeply into what you're doing?
Yeah, so the only thing I wanted to share was two things. Okay, so this graph shows what our historical combined model allocation has been, with the darker orange being the historical daily allocation. You can see that we've got to be short at this point. We were longer on the dip because valuation came down enough, but right now valuation is such that it says to be short. Did capture, into a neutral and then short position this decline back here, and you can see that's back in the early days, because valuation was so low in 2013 and 14, the model was generally levered long. The last thing I wanted to share is the characteristics of the returns of the combined strategies, which in back testing is, and even though I've been sharing my stuff publicly for 2013, Dan's model is pure back testing. The combined models have pretty attractive characteristics in terms of return, but also Sharpe and Sortino ratios relative to the S&P 500, and drawdown characteristics as well. So I just wanted to share that. I will be glad to make the presentation itself available. I'll just have to, I don't know whether you guys like to put stuff up on your website, but otherwise I'll be glad to put it up via my Twitter feed somewhere along the way.
Okay. Well, I really appreciate you coming here and sharing what sounds like and probably is your life work with us today.
Well, this is definitely my life passion. So, I enjoy being an actuary, but this is really what I love to do. So,
you action junkie. All right, I'm just kidding you. It was great meeting you, Peter. You're now my trading warrior brother. I wish you much success, and may all your signals work out eventually.
I appreciate it.
All right, so Peter Reilly, everybody, and here's his contact information. Peter Reilly, K Reilly, which is his handle on Twitter. There you go. Take a screenshot. Okay, they're thanking you, Peter, for being here. And I appreciate you spending your most valuable currency, which is time, a half an hour with us on F.A.C.E to, tell everyone what you've discovered over your career, especially with your background, your mathematical background. So thanks again, Peter.
Oh, my pleasure.
And everyone have a great weekend. Enjoy, do your work. Peter, don't you find you really see the markets much more clear on the weekend when they're closed? Some of my best trades are, done on the kitchen table over the weekend. And then you're just prepped to execute.
It removes the emotion of the real-time decisions that traders make.
Yeah. No impulses. That way you help. If you have it planned, you're less likely to say, "Hey, that looks okay. I'll give it a shot." So again, Peter, have a great weekend, and we'll be in touch. And that's a wrap, everyone. Thank you for your attention. Remember, don't just count your returns. Remember that reversion to the mean is being grateful. And so don't just count your pips, count your blessings, and we'll see everyone Monday. All right. You're welcome, Leon, Sinatra, everyone. That's a wrap. I'll see everyone on Monday. Adios.